Look at the sheer physical scale of modern maritime commerce. A single cargo vessel loaded with thousands of containers represents hundreds of millions of dollars in capital sitting exposed to the elements. This diagram illustrates the primary financial hurdle for shipping. International trade runs on credit, but banks refuse to discount a bill of exchange without specific collateral to offset maritime risks. There is no formal legal statute forcing a merchant to insure their goods. However, the international banking system's requirement for security makes it a de facto condition for transit. Without coverage, the risk remains unmitigated, and the vessel remains idle. The legal framework that provides this financial validation is the Marine Insurance Act of 1963. Section 3 of the Act defines it directly. It is an agreement where the insurer undertakes to indemnify the assured against losses incidental to a marine adventure. To understand this system, we will analyze the architecture of marine insurance from its first principles. We will trace its evolution from 14th century loan bonds to the 8 specific scopes of liability used today. Maritime trade requires moving physical vessels across oceans, but it relies on a structured legal framework to convert the chaos of the sea into a quantifiable financial model. The necessity of managing maritime risk dates back to the 12th and 13th centuries with Jewish and Italian merchants. By the early 14th century, Italian traders had developed a system for early capital allocation. This diagram shows their 2 primary mechanisms. On the left, bottomry, a loan raised on the vessel's security, entirely forgiven if lost. On the right, respondentia, an advance secured strictly against the cargo, repayable only if it arrived safely. Over the centuries, the center of this capital market shifted geographically. The practice prospered in England, and by the early 18th century, individual underwriters were conducting this business in London's narrow streets and coffeehouses. One specific location, Edward Lloyd's Coffee House on Lombard Street, attracted a critical mass of traders, boat owners, and bankers, establishing itself as the global center for marine underwriting. By 1871, this hub was incorporated by an Act of Parliament into the Corporation of Lloyd's. As you can see in this underwriting room, a critical distinction emerged. Insurance seekers placed their risk at Lloyd's, not with Lloyd's. The corporation provides the facility and framework, but the actual financial risk is absorbed by individual member syndicates operating within the market. To monitor these global investments, Lloyd's appoints agents worldwide. These independent entities gather shipping intelligence and arrange damage surveys. They do not draw a salary from Lloyd's. Rather, they charge fees for the specific services they render. Relocated to this high-tech building in 1986, the modern Lloyd's market operates at a massive scale, ensuring almost any conceivable risk through this established framework. The institutions evolved from early Italian bonds to these towering modern syndicates, yet the underlying mechanism of segregating and absorbing maritime risk remains consistent. Returning to the legal codification, Section 2D of the 1963 Act strictly defines the marine adventure. As shown in this model, the legal adventure extends beyond the ship. It includes the exposed physical property, the expected freight earnings, and the liability to third parties that may be incurred. This property must then be evaluated against Section 2E, which defines maritime perils. These perils include natural events consequent to navigation, like storms or fire, as well as human-driven actions such as pirates, thieves, captures, and barratry. Coverage is divided into specific scopes. Hull and machinery covers the vessel. Cargo protects goods in transit. Freight ensures payment liabilities. Finally, protection and indemnity, P&I clubs, absorb operational risks like pollution, port damage, or crew injuries. The framework also includes operational scopes like time charterers' liabilities for cargo handling and builders' risks to cover vessels actively under construction. Finally, because global supply chains require multimodal operations, liability extends to inland transit entities. Truck operators and inland container depots carry exposure for cargo damage. Modern maritime coverage functions as a highly compartmentalized stack of individual protections, mapped exactly to the distinct vulnerabilities of the physical supply chain. Entire nations must build regulatory architectures to handle these massive capital requirements. India's historical trajectory provides a clear case study of this evolution. During the colonial era, the Indian market was highly fragmented. It grew to 176 companies before the Insurance Act of 1938 imposed strict state controls to protect domestic interests. A major structural shift occurred in 1972 when the government nationalized the entire general insurance business. This chart shows the administrative structure of the GIC. The state created the General Insurance Corporation of India, tasking it with superintending 4 merged subsidiaries. It also acted as the designated national reinsurer, taking 20% of all gross direct premiums. Beneath the GIC, these 4 subsidiaries, including New India Assurance, headquartered here, were designed to remain competitive business entities operating from distinct regional centers. The market began to open following the Malhotra Committee reforms of 1993, eventually leading to the creation of the Insurance Regulatory and Development Authority. As seen here, the IRDA dismantled the state monopoly. By 2002, the General Insurance Corporation was delinked from its subsidiaries. The 4 blocks became independent, and the GIC shifted to focus solely on reinsurance. The final phase of this liberalization arrived in 2007. The fixed rates prescribed by the Tariff Advisory Committee were completely removed, forcing the market to adopt competitive free market pricing models. India's market evolution tracks a continuous recalibration of risk. It progressed from colonial underwriting through state-mandated nationalization and finally to an open market. We now have a fully covered vessel, legally and financially prepared to begin its marine adventure. This impending voyage is backed by strict doctrines embedded within the 1963 Act, including utmost good faith, indemnity, and subrogation. However, there is a critical caveat to this entire structure, found in Section 41. Under a voyage policy, there is a strict implied warranty that the ship must be seaworthy the moment it commences the journey. This diagram highlights the impact of Section 41. If the assured knowingly sends an unseaworthy ship to sea, the insurer is completely absolved of all liability. This single clause forces shipowners to maintain rigorous physical safety and maintenance standards. They must protect the vessel to satisfy their financial collateral requirements. Marine insurance serves as the codified enabler of the global supply chain, allowing high-risk physical transit to proceed. We have watched this system scale from 14th-century coffeehouse syndicates to complex de-tariffed statutory networks. By legally compartmentalizing the inherent perils of the sea, marine insurance provides the security to sustain the banking capital, keeping the modern world moving.